Hi, good morning everyone. We are starting the webinar. We're starting the webinar now. Okay, we'll have a results update for Cash Logistics Trust, SMRT, and OSIM, followed by an in-depth update of global logistic properties. So first is Cash Logistics Trust. The top table shows the fourth quarter year-on-year results comparison, while the table at the bottom is the full year-on-year results comparison. So you can see here gross revenue was up almost 17%, this in the fourth quarter, mainly due to contributions from the 6 Australian properties that were acquired in the first quarter and fourth quarter. First quarter there were 3 in the first quarter and then another 3 properties in the fourth quarter. Net property income for the quarter was down 1%. This was due to decline in overall portfolio occupancy and the higher expenses associated with the conversion of 4 master leases to multi-tenancies. Distributable income up 4.7%. This includes the partial capital distribution of 2.12 million from the proceeds of divestment of Kim Heng Warehouse. This was in June this year. June last year, 2015. So for fourth quarter, the DPU was down 3.4% year-on-year. This was due to the larger unit base. If you recall, in the fourth quarter last year, they did a placement and they raised 100 million. So this DPU in the fourth quarter of 2.074 cents. This includes a partial capital distribution from Kim Heng and as well as the advance distribution of 0.9 cents that was paid on 29 December. This advance distribution was the share of returns that was due to the original unit holders before the placement. Now moving on to the bottom table that shows the full year results. So same for the gross revenue, there was an increase. This came from the contribution from the 6 acquisitions in Australia during the year in first quarter and fourth quarter. Same for net property income, it was down 2.4% due to a decline in the overall portfolio occupancy as well as the high expenses associated with the conversion of 4 master leases to multi-tenancies. Distributable income was up 1.6%. This includes the partial capital distribution. This came up to 5.08 million for FY15, and DPU was down 0.9% year-on-year to 8.5%, again due to the larger unit base. And this also includes the capital distribution from Kim Heng Warehouse as mentioned in the cell above, about the 5.08 million, and as well as the advance distribution. The key takeaway for this quarter for cash, firstly, is asset values did not hold up. Their Singapore portfolio of warehouses at the end of this financial year was revalued downwards by 46 million. Originally, it was worth 1.1 billion, so now it's less 46 million. This was attributed to the conservative assumption of slower growth and lower rents. And 2 of their properties have less than 20 years of the land lease remaining. So the relatively shorter land lease expiry also played a significant factor in the revaluation. Renewals and new leasing has been sluggish, so In the fourth quarter of last year, they had 2% of lease expiries by gross rental income, and this 2% was unrenewed. So, but to put things in perspective, this 2% represents small pockets of spaces within the portfolio. The other thing is that the master lease for Air Market Logistics Centre, which is due in 18 August this year, 2016, it was forward renewed with a single-digit negative reversion. This is also in line with what's going on in the sector at the moment. Like, for example, um, if you follow Sabana REIT as well, they had some master leases that were renewed, and these master leases were also renewed with negative rental reversion. Uh, the other thing to highlight in terms of their sluggish leasing is DSE Arc, which is their newest building in Singapore. It was a built to suit for DHL. This building is currently, or rather, this property is currently 82% occupied. It consists of two blocks, Block 1 and Block 2. Block 1 is 100% occupied by DHL, and it has a 78% weightage by NLA for this property. And Block 2 is the REIT has reported that Block 2 has been slow to fill up. It's currently 19% occupied. One of the hindrances or difficulties for Block 2 is that because of it can only be leased out for a tenure of 2 years, after which actually DHL has pre-committed to take up the lease for Block 2. So for cash, they need to find tenants who can fulfill this requirement of only leasing it for 2 years or less. So going forward, what to look out for this year is that they have 12% of leases by GRI which will be expiring, and this is actually in the second half of this year. Majority of this 12% predominantly will come from Schenker Mega Hub and High Speed Logistics Center. These two are also on master leases, and we think that it's likely they will be renewed with negative rental reversions as well. That's best case. Worst case scenario is that renewed and converted to multi-tenancy. To sum up, from the divestment of that Kim Heng warehouse, uh, they remain 4.2 million. So it was divested for 6.7 million in June 2015 and realized a gain of 0.7 million. After distributing 5.08 million across the 3 quarters, they still have 4.2 million to go. Okay, so for cash, I think that there's a tough times ahead for it. While pre-commitment for new warehouse space is high, between 72% to 78%, but this is also an opportunity for shadow space to be created. Uh, Downward pressure on rents is expected to maintain, and uh, sorry, downward pressures on rent will continue in light of the REIT's desire to maintain occupancy. So what's happening is that the REITs are saying that mm, in view of the large supply, they are very keen to maintain occupancy, because if they allow their current tenants, if they do not manage to get their current tenants to renew and these tenants leave the property, they will find a hard time to find new tenants to lease the space. So As such, the REITs are prepared to lower their rents in order to retain these tenants and to maintain their occupancy. Um, so as you know, 2015 and 2016, we'll see a large supply of industrial space coming up, and there could be an overhang of supply going into 2017 coming from the overflow of unabsorbed space during 2015 and 2016. Uh, there was quite a fair bit of unit holder dilution in the fourth quarter last year when they raised 100 million. So further unit holder dilution is a matter of time again. The leverage is now currently quite high, 89.8%, and they have a quite low debt headroom of about 118 million if you assume a 45 gearing target. So this 118 million debt headroom is quite small, and it leaves them very little room for acquisitions. And anyway, the leverage is already almost at 40%. So uh, they probably would need to do some kind of um, fundraising as well. But at the same time, the weak price is inhibitive for another round of EFR, in light that the last one was just done in the fourth quarter last year. The other thing to note about a discount to book is that it, in this situation now, it doesn't appear to offer any downside protection. As I mentioned earlier, the Singapore portfolio was revalued downwards by 46 million, uh, and the overall portfolio was revalued downwards by 65 million. This also includes some currency translation losses from the Australia side. So if you look at this bullet point here, fourth quarter NAV it ended at 88 cents. If you compare a year ago, that was 98 cents. And just 1 quarter ago, in the third quarter, it was 96.9 cents. So if you look at this 65 million revalue downwards and you divide by the number of units, it effectively erased off 7 cents uh, of NAV per share, just overnight like that. Okay, next moving on to SMRT. So as you know, SMRT had a positive earnings surprise. This table, the top half shows the revenue for the various business segments. Here, this is the revenue part. And then at the group level, revenue. And then this table here at the bottom half is showing the operating EBIT for the various segments. So you start from the top, see all green arrow. There was broad-based growth in revenue across the group. So we'll look at the first three first, which is the fair revenue segment. So fair revenue all grew, mainly due to higher ridership. For MRT and bus, there was higher average fare as well. Taxi revenue also grew due to larger and newer fleet. Rental revenue grew due to Kallang Wave Mall and leasing of commercial spaces at the MRT stations and bus interchanges. And then lastly, advertising, which also grew 5.8% due to increased advertising on trains and buses. Okay, so to summarize, for revenue, it grew 4.6%, mainly due to broad-based growth across most of the segments. For MRT, the EBIT grew by about 6 million. One of the biggest chunk came from this grant from the government, which is valued about 3 million. So this is non-recurring in nature. The other component that helped to improve the EBIT for the MRT segment was the lower fuel cost. Bus, again, it's had its fourth consecutive quarter of profit after registering losses for several quarters. Taxi also had improvement in EBIT due to higher rental contribution and early retirement of older taxis. So in whole, the EBIT also grew, but partially was due to this one-off grant. And lastly, PATMI was higher, coming from higher profit from MRT and taxi. Okay, so some of the bullet points for this SMRT is that they did a sale of buses to LTA in the fourth quarter. They sold about 110 buses, and this was at book value of 30 million. There will be no cash flow impact, as the government had given them a loan to purchase the buses, and so the sale of the buses, the loans will be repaid and offset. So it will be cash flow neutral as well as balance sheet neutral. The management from SMRT have given the outlook that they are expecting their train and bus revenue to be impacted on two fronts. Firstly, this is the 1.9 fare reduction that came into effect from 27 December, as well as cannibalization of ridership by Downtown Line 2. So Downtown Line 2 runs parallel to some of their bus services, as well as a section of the north, south, east, west line on the western part of Singapore. So they are expecting about 4 to 6 million less revenue. And this will be in the they are expecting this ratio to be about 80 to 20 in a ratio of 80-20, with train 80 and bus 20. For rail maintenance related expenses, this is expected same as the previous quarter. This is expected to creep close to 50% of rail revenue. So to elaborate a bit more about this rail maintenance related expenses, this comprises staff costs and repair and maintenance components. So the last bullet point on this page, I've already spoken about it in the previous slide. For the higher market profit in the quarter, this was boosted by the one-off grant. Okay, hand over to Lin Xin now, who will give an update for the OSIM results.
Morning, everyone. This is Lin Xin. So I'll just give a brief update on their recent results. Okay, so for OSIM, as you can see that compared to their last year, their 2015 full year earning is down due to a big demand across the board. Across their 5 key core markets, China, Hong Kong, Taiwan, Singapore, and Malaysia. So, but the management said that Hong Kong is still holding up. Singapore in particular is weak. And for Malaysia, the volume is still there, but highly affected by their weak currency. And as you can see that for their EBITDA, it's affected by their legal costs, which total up to 10 mil last year. If we exclude this one-off expenses, their EBITDA is still remains above 100, 107 in fact. So it wasn't that bad per se. So although that during this big macro landscape and there's two huge one-off expenses, one being the legal costs as I mentioned earlier, and the other one would be on the deconsolidation of their Oni Australia. So they have actually exited the nutrition market in Australia. So adding up, this actually pressured their downline, giving their profit after tax about half as compared to 2014. So, but the good thing is that they actually maintain their gross margin at above 70%. In fact, they have a slight improvement on their gross margin. For last year, 2015, they actually increased 1 percentage point up as compared to 2014. And given the big macro outlook, management shared that they expect an easier labor market as well as a rental market, especially in Singapore. So that should be able to see some margin improvement from there. And for their currently they're still waiting for their verdict, but management also expect that there should be a much lesser legal cost to incur next year. These 3.5 million freed up a year, resulting from the deconsolidation from the Oni Australia. So this free up cash flow and expenses would be used to invest in other expansion, particularly the management mentioned to expand in their Taiwan market. So they are currently focusing on North Asia side. So they would want to expand their GNC stores in Taiwan to make them. They have a very high prospect over their Taiwan nutrition market. So later I'll touch a bit more on the store expansion. So to talk a bit about their product pipeline. So they have actually scheduled one blockbuster massage chair to launch probably by mid of the year or early of the second half. This should be able to prop up their top line, and also they have already scheduled a few small ticket items to be launched quite soon. And although that we have been seeing a lot of market news regarding big Chinese consumer market, but the management shared that there's a limited impact from China sales because China only contributed about 20% of their total sales. And as mentioned earlier, their Hong Kong businesses are still quite strong. And to address the big demand from China, they have actually looked into the growth prospects in their online sales. So for last year, they have shared that their online sales have more than doubled. And for their online sales strategy, they're actually offering a different products as compared to their physical stores. So these products would not be seen in their physical stores, and it's relatively much cheaper than what they're selling on the in the stores. So this would also provide different price points for consumer to enter. They also shared that these products usually will range about 10k to 20k renminbi. Although that's much higher than what their peers are offering online. Their peers usually will offer about 3K to 5K renminbi online, but that also means that the management would not want to dilute their brand equity. They would still want to stay within the premium range, although that their online products are relatively cheaper than the physical stores. And also they would like to promote more sales under installment plans, as they've shared that currently about less than 10% of their total sales in China are under installment payments. That compared to developed markets, 70 to 90%, particularly in like Hong Kong and Singapore. So there are much more potential for them to grow in China to reach that level. One of the reason or challenges that they are facing behind these low installment plans sales is because of education or culture difference. Because for China, consumers buying on credit may imply that the buyer may be might not be financial able, so they have to pay in credits or installments. So in a way, they would like to educate the consumers more, and they are currently in collaboration with Taobao and JD.com to grow their online sales. Okay. To touch a bit on their stores count. So as you can see that from this chart, they are still on track on their stores rationalization. And you can see that from here, the GNC segment, they've closed quite a lot last year, mainly due to the deconsolidation of GNC Australia. However, they are still positive or optimistic about the North Asia market, so they will continue to focus to grow their markets in China, Hong Kong, and Taiwan. They target to open about 5 to 8 GNC stores and 15 to 20 TWGT stores this year. For last year, the management guided that they are going to open about 15 TWGT stores, but they have only opened about 9 stores last year. One of the reason is because it's hard for them to employ sales and management staff. So some of the plans are being postponed to this year. So hence the 15 to 20 TWGT stores. And we are positive that after the expansion and everything, they still would be able to generate a positive free cash flow. They've announced a final dividend of 2 cents per share last year, so giving a total of 6 cents per share. The management also guided that they will try to maintain 6 cents per share for this year, despite slowing sales. And that would translate to a yield of about 6%. So this actually give quite an attractive dividend yield. So as mentioned earlier on regarding the challenges, we have actually reduced our target price from $1.44 to $1.35, but we have maintained a buy call. And with the lower 2016's expected earnings, which would translate to a 15 times P ratio. That is about the 5-year average of OSIM's PR. So, yep, just to reiterate, we maintain a buy rating with a lower target price. With that, I would like to pass on the presentation to Peter on GLP.
Morning, everyone. This will be an update on global logistic properties or GLP, and this is a long due update. And please do not be mistaken that there will still be an earnings update this coming Friday. Oh no, sorry, this coming Thursday, as they report their third quarter. So without further ado, let's get into it. Okay, so for the past 3 quarters, what happens is that GLP went into the US and they invested a sum of $13 billion into two fund management platforms, which is US Income Partners 1 and 2. So this provides an engine for growth apart from the three geographic locations that they are in. Currently, before they entered into the US, they were in Brazil, China, and Japan. So the entry into the US is mainly to ride on the recovering US economy. Well, now we move on to the China Development Program. In just in December itself, they acquired a 15% stake in China Materials Storage and Transportation Development Company. This is one of the largest state-owned logistic warehouse providers in China. And upon the acquisition, they have set up a joint venture with the company. We shall get into it in a few slides later. Next, still on China, they have established a new development fund, which is CLF2. And what's encouraging is that this is the second development fund in China where more than 50% of the investors are from the first fund. Next, we see that there are some signs of stabilization in China amid recovering lease ratios and resilient rentals. So lease ratios in the first quarter dipped to 88%, but subsequently recovered 1 percentage point upwards to 89%. We'll get into it a bit later. And the other thing about rentals is that we have not seen any fall in rentals. In fact, rentals have continued increasing. And this is backed by the robust demand for leasing space in China. Okay. Now, I'll skip the next 2 points because I'll get into it just in a few slides later. Okay, now we'll go back to the US. They established GLP US Income Partners 2, which represents the second tranche of investments where they directly acquired a US REIT comprising $4.6 billion of Class A industrial properties. And this overall portfolio size has expanded GLP US size by 50% to 16.1 million square meters. And with that acquisition completed, GLP is ranked as the second largest logistic provider in the US after Prologis. These properties were acquired at a cap rate of 5.7%, and it was in line at the point of time, in line with the national cap rate. And just last Friday, Prologis just announced their quarterly results. The US portfolio for them came in at a cap rate of around 5.1, 5.2%. And with that, we should expect some form of cap rate compression in the near future for GLP. Now, in terms of operational, lease ratio climbed 2 percentage points to 94% just in the second quarter. And this was backed by good demand for space on the ground, or strong demand for space on the ground, as 9.6 million square feet of leases were renewed or newly signed. So on the part of rent growth and same property net property income, they were up 5.3% and 8.9% year on year. Okay, now we'll take a look at the supply and demand dynamics of industrial properties in the US. So industrial properties itself, they took a positive turn. I mean, we see very healthy demand for space, because it just bring everyone's attention to the chart itself. For the past 5 years, the dark green bars that is the amount of demand for space on the ground. While for the light green, the light green bars, these are the supply in the market. So you can see just in 2014, even though between 2011 and 2014, even though supply continued to increase, but we can see that the longer dark green bar means that the demand for space definitely outpaced the amount of supply in the market. And this is a good sign for sure. Now we go to China. They've acquired a 15.5% in CMS-TD. Like I've said just now, this is one of China's largest state-owned warehouse logistics provider. And at the same time, they've established a JV company, which is to invest another $562 million to develop 1.3 million square meters of buildable area across China. And we And the other thing which about this investment is that GLP will be able to redevelop CMS-TD's existing land and facilities. So, and secondly, they will also get they will no, they will also gain access to more than 9 million square meters of CMS-TD's land resources, and this is on top of the 12.5 million square meters of land reserve which GLP currently has. So with this with the access to CMS-TD's land resources, it essentially doubled GLP's land bank. Next, they've established this CLF2 fund. It was set up in July 2015. The assets under management on AUM is $7 billion. This is 2 times the size of the first fund. And the first development or construction which we scheduled in April 2016. And we are generally positive on this fund setup because it represents confidence from the first tranche of investors, because more than 50% or 4 out of 7 of the investors are from the first fund. Okay, now on the development segment or development business, the second quarter's value creation margin was slightly below expectation. Now we just visit value creation margin for a second, because since it's been quite a while since we our house has updated on GLP, so it's good to refresh everyone's memory on it. So value creation, in other words, is fair value. How is this created is the difference between GLP uses development start and development completion. For development start, essentially is how much construction cost and what kind of land cost is used for construction, while development completion encompasses the underlying fair value gains. That's includes the underlying fair value gains. So the difference between development complete and development start will give you a value creation, and of course the amount made is the value creation margin. And just in second quarter itself, they registered a value creation margin of 24%. This is in line with the benchmark that GLP has set. And when it comes to China, development targets were trimmed by 17.2% to US 2.9 billion because of a slightly weaker environment in China, as well as there were some hurdles in regulatory approvals. Therefore, some of these development completions or development starts and completion, there were some held up there. But nonetheless, they have already met 44% of 2016's development start target. But for completion, it's only at 18.3%. Now I move to Japan. We saw a much weaker value creation margin, and that was because 2Q came in much weaker at 23%. So the first half value creation margin was down to 16%, and this is significantly below 25% of the projected value creation margin which GLP intends to aim for. Now, we are in rental and related income. So as we know that China has become the primary market for GLP after they FO IPO, and even though there are some woes of slowing growth in China, but leasing demand for space and modern logistic facilities are still strong because there's a undersupply of modern logistic facilities. And over to Japan, revenue contribution, we see that it continued to slide, but we think that it should have reached some form of stabilization because um, no, I'm sorry about it. So we see revenue continue to slide for Japan because 5 of the properties in under GLP, 5 Japanese properties under GLP were actually disposed into the REIT level or GLP-J REIT, which GLP owns 15% stake in. So GLP-J REIT, it provides GLP with a long-term vehicle to unlock the underlying value of its Japanese property. Because just now we talked about value creation margin. Essentially, fair value creation margin, these are just fair value or paper profits. In order to recognize them, there needs to be some form of selling. So this is where a REIT becomes useful. And GLP-J REIT now has a right of first look on 20 other properties. They are valued at US $1.8 billion. Okay, now move on to their fund management platform. AUM has grown to US 32 million, US 30, 32. Sorry, there's a typo error here. It's 32 billion, not 32 million. So if you include GLP US income partners too, but this has not been reflected into their platform yet because it has not been completely acquired. But nonetheless, in FY15, in financial year 15, and the second quarter of 2016, the growth in AUM was mainly as a result of the setup of CLF2 or the second development fund in China. Okay, next. Just now we talked about signs of stabilization in China. We talked about this already. So, but one thing that I did not point out is that overall lease ratio, property lease ratio, or the group's lease ratio is standing at 93%. Okay. Now next. We mentioned about the strong leasing demand for space in Japan, and we think that even though rental continues to slide, but because there's a strong demand for space, like I've already emphasized quite a few times, because just in Japan itself, in the second quarter, there's a record 320,000 square meters of space that were leased just in the quarter itself. So compare this to the all-time high. Compared to all-time high, it's a 50% increase. And rental growth on renewal was up 14% year-on-year into 2Q16. For Brazil, we understand that, and we also do see that there are macroeconomic headwinds, but this is not a complete picture because, in fact, Brazil has continued to deliver. Lease ratio is holding up to near full. It's at 95%. Furthermore, rental has not declined at all for the past 4 or 5 quarters. It's still very strong on the ground. And then again, growth in monthly rental and same property rental have also been encouraging. It's up 7.7% year-on-year. Now onto its balance sheet. Net gearing stands at 15%, and this includes the proceeds of the pairing of GLP US Income Partner 1 to a 10% stake. So at 15%, it's much lower than GLP's mandate of 40%. And if we include the $1.5 billion through the pairing of stake of GLP US Income Partners, it will have a cash balance of $3.1 billion. And this deal has already been completed in November 2015. So meaning that we should see this amount coming into the third quarter, which they will be announcing in this coming Thursday. Okay, we just touched on a bit about the just try to understand more about the demand that is the demand driver that is driving the take-up for logistics space. So as the slide has mentioned, the key demand driver behind logistics space is actually domestic consumption. And as we see that um, demand for logistics space will continue rising as China's economic structure shifts towards one that is traditionally dependent on exports and investments to one which is dependent on consumption and services. And if you just look at the chart here, the green line is China. Household expenditure to GDP is only at 36%. So if you look at the other developed countries like Japan, even Europe, or the US, it's easily 50 or 60%, meaning that there's much more room for growth here. Next, we're diving deeper into the household expenditure in China. Okay, as stated, household spending in China currently made up 36.5% of GDP compared to developed nations, which is around 60%, which I just shared in the previous slide. Household spending has been growing at a CAGR of 8.12% for the past 15 years or so. And if you just, if you just look at the bar here, it is very clear that this household spending or GDP contribution from household spending has been continued increasing. Okay, now with domestic consumption, the next thing to look at is the retail sales. And retail sales in China essentially quadrupled between the last decade. So, and the rapid growth is because of the growing number of middle income households and disposable income. Next, the growth in retail sales the growth in retail sales has averaged 15% between 2005 and 2015. So this is still a double-digit growth, or essentially 2 times more than how much its GDP is growing now. And the fact that I've been talking about household income, talking about expenditure, talking about retail sales, all these will eventually lead to businesses. They have to improve their value chain. And when you talk about value chain, it will not exclude things like distribution, things like logistic facilities in particular. So therefore, when businesses transform, there will be a driving demand for logistic space, and in the form of warehouses, storage space, and more importantly, this is all there to support distribution needs. And as it's probably not new to anyone here, but traditional retail is slowly transforming into e-commerce. So, and the reason here is because of the rising acceptance of online purchases that has driven the explosive growth in e-commerce or e-commerce activity. But nonetheless, when it comes to China, there are numerous factors why e-commerce activities have been picking up. But more importantly, if you want to quantify it, internet penetration rates is one of the key factors to look at. I mean, think about it. If you can't even access a computer, you will not be able to buy anything on the internet, even if you choose to do so. So again, we look at the chart here. For China, internet penetration rates is at 46%, and this is almost half compared to a developed nation like Japan and US. In particular, for China, right now it's standing at 46%, and the other one is is Brazil, which is at 52%. So there's still much more room for them to grow. Now, for e-commerce, we are still seeing rather explosive growth for e-commerce companies. So we bring everyone's attention to the chart here. The combined sales of the three largest players, e-commerce players, Alibaba, JD.com, and China Tangtang, the the growth the growth has been very high. So if you look at Alibaba and JD.com, it's easily 30% and upwards. And then again, just to be clear on this chart, this is the 9th month of 2015. It's not even a full year yet. It has already grown at amounts that are 30% more than the full year in 2014. And even though there's a rich existing supply of logistic facilities located in China, but modern logistic facilities only account for less than 20% of the total supply. And why is modern logistic facilities important? Because of the, like mentioned, the changing landscape, the changing business landscape. So compared to a traditional business, an e-commerce business, the specifications that they require is much different. Think about it. For e-commerce business, easily one day transaction goes in hundreds of thousands, or even the bigger one, millions of transactions. So there's a lot of throughput within a facility. So if you look at a modern logistic facilities, you could have as many as 240 doors in one facility. Compared to a traditional one, it could be like 6 or 12 doors. So therefore, all logistic facilities are not able to serve the newer ones. Now, these are the investment merits of why you should look at GLP. And the past few slides, we actually talk about we talk about e-commerce, we talk about domestic consumption. So in fact, for e-commerce businesses, currently in Brazil, 18%, China is 26%, Japan 12%, and US 10%. These percentages are the amount of e-commerce business that is currently occupying GLP's portfolio. Next, there is this thing which GLP always emphasize on, which I think that it's a strong competitive advantage. That is the network effect. Why is it so? Because of GLP's expertise in development. Furthermore, they can develop very quickly, less than 1 year. So for those high growth businesses like JD.com, which is the largest e-commerce player in China, imagine if they want to expand quickly, and go into other cities. First, they have to access. They need someone who they need a partner who can develop quickly. They also need a partner who has the resources to develop as well. So in that case, GLP is able to fulfill all this. Not everyone will be able to. I'll put it this way: not every logistic providers are able to deliver like what GLP can do. So just in FY 2015 itself, 60% of new leases were signed from existing tenants. Okay. Then next, they have a well-managed fund management platform due to 3 reasons. Because the fund management platform grants them the access to reliable third-party capital. And these funds, joint venture partners of these funds include people like, GIC, which is already a strategic partner of GIC, who owns 36% in GLP. There's CPPIB, which is Canadian Pension Fund Investment Board. They are also partnered with GLP in the China Development Fund. So more importantly, why is it reliable is that these players are in for long term. The last thing that you want is people cashing out their investments within 1 or 2 years. So when so when that happens, it's no longer that reliable. Next, they are able to deliver risk-adjusted returns because they don't fully own a stake in in all the funds itself, but instead is diversified. The risk is diversified across all the joint venture partners. And next, market share is also it will also become it also potentially increases its market share because of the larger access of funds. So this all at the end of the day, all three factors will be able to boost its network effect. And finally, as we spoke before, balance sheet is still very conservative, which we think is a good thing at this current economic environment. So at we think that for the third quarter's net gearing, it should stay low at around 15% ish. And more importantly, they have a rich cash of US $3.1 billion or net debt position of $900 million. And finally, we come to the investment risk. Well, I mean, there's nothing new to everyone, perhaps. I think that there are headwinds in a macroeconomic environment. So if there's a further slowdown, that might potentially lead to a slower demand for space in some of the key markets that they are operating in. Secondly is further delays for government approval for developments in China, further slowing the development business. Third thing is foreign exchange volatility in terms of the three currencies that they're exposed to. GLP uses a natural hedging strategy. So if there's a significant depreciation in any of the currency, then it might run into foreign exchange risk or losses. Okay. Finally, this is the RNAV breakdown. It breaks down the value of the four portfolio, which is China, Japan, Brazil, and US, along with the other investments or strategic stakes that they have taken up. They are CMSTD or we have actually just mentioned, which is the China warehouse facilities provider, GLP JREIT, as well as a strategic stake in this Shenzhen Petroleum. Uh, uh, okay, it's actually It's actually another company that's listed in Shenzhen. So if you total up everything, including the fund management platform, we get a gross asset value of 11.1 billion, which is equivalent to around $2.33, and minus away net debt position. And in this case, we reclassified these capital securities, which is a form of perpetual securities, into debt. So with that, we get a RNAV per share of $1.72 US dollars. And when convert it back to Singapore dollars, we get $2.48. And this is a pure comparison table, and with some graphical representation of the key operating metrics of GLP. So for that, we've come to the end of our presentation. Feel free to ask any questions if you may have.
Hello, this is Richard speaking. There was this question for cash about the remaining 4.2 million from the divestment of Kim Heng warehouse. Um, yes, the management have said that they are committed to paying it out. Um, we think that they will finish paying it out by second quarter of this year. The assumption is that they will try to maintain the level of DPU year on year to be at least flat. So if that's the case, then they will the this remaining sum will be depleted by the second quarter. To deal with some of the other questions that because this question has been there are several participants were asking about the archive of the previous webinars. So actually at the moment we are going through an IT upgrade. We're upgrading the website. So there's a new site where the archived webinars are located, and as well as the PDF file for the presentation. Uh, we'll provide the website in the next webinar on this last page that we're displaying here, and you can click on it. But verbally, the or rather, okay, I'll type out the website there, and then you can follow the links, and I'll it send the web address to you through this webinar here, and then you can copy and paste it. Hi all. So I've sent the link to our new webinars archive. So you please look for the link in your message box in the webinar interface. So for once you go there, if you want to access the PDF, you have to click on the link to view the webinar, and then there will be another button below that says view PDF. So then you click on that in order to download the PDF.
Hi, this is Peter speaking here. There are a few questions about asking on the price weakness, the recent price weakness of GLP, and more importantly, I would say that the fundamentals are still strong. The fundamentals, in fact, are very strong, as shared in the presentation. But nonetheless, the recent selling, first thing first, would be the volatility in China. That's possibly the main thing. And the other thing is that if some of you actually do follow GLP, the CEO has how should I put this? Well, has actually sold off 15 million shares, and it's not him going to the market directly to sell it, but in fact, it was collar strategy or collar transaction option strategy that it went into. So a strategy like this will perform very well in a down market condition. So the next question to ask is that is he actually foreseeing price weakness in GLP? I mean, if I would say yes, if it was entered within like the past few months, but this transaction, this 15 million shares, this particular transaction, it was entered in 2012, the beginning of 2012, or 4 years ago. So if you look back in history, that that period of time also a lot. There was also a lot of volatility in the market. This is particularly related to the European sovereign debt crisis at the point of time. So then let's just summarize this. Fundamentals is definitely strong, but when it comes to the recent price action, this is not something that we that we can control. I mean, as investors, investors like us. I mean, what we can the due diligence that we can do is to assess is to find a good company to invest in. But how the market prices it in the short term, nobody can control it.
Hi, there's a question on view on SingPost. So actually at the moment, we don't have coverage on SingPost, so we can't give a view on it.
there are no more questions, we will call an end to our webinar. By the way, there won't be a webinar next week because, as we all know, it's Chinese New Year next week. So we'll see you back the subsequent week after Chinese New Year. Happy New Year to everyone, and we hope to see everyone back.